Ladies and gentlemen, welcome. In about 10-15 minutes here, we're going to see JPOW address the nation. Been waiting all afternoon for this. Now, at first, my daughter didn't want to go to sleep, so I thought about just leaving her in her crib wide awake while I come and do this. Because I'll tell you what, I'm not missing JPOW's announcement. Hey, somebody let me know in chat, how's my sound? Hey everybody, hey Gavin, hey Wolf Theta Gang. Let me know how my sound is, because I'm trying to change the way I get sound from my computer. I changed up my settings on OBS, so I want to make sure you guys can all hear me. Can you guys hear the music as well? Is the music coming through clearly? It just paused for a sec, but sounds good, good, good. Okay, awesome. So what I'm expecting from JPOW today is that they're going to tell us that they are, one, not going to raise or lower any interest rates. I think that's pretty much a given. And number two, I expect them to give us a heads up on when we should expect them to stop buying bonds. Corporate bonds, that is. So far, they haven't made any moves towards stopping. I think there's going to be a lot of pressure on them to do that. Yeah, music is just quiet in general. How's that? Are you guys getting more music now? I don't want to overpower it either. No more voice. I'll let you guys tell me. I try to turn up the sound. Casper Lax, how did you lose 40? You ripped a 40% gain last week. All right, congratulations. I thought you were about to tell me you RIP'd a 40% loss. What I'm thinking we're going to see from JPOW today, like I was saying, was they're not going to change the interest rates. I'd be astonished if they made that move. I do expect that they're going to give us a heads up about when they will intend to, and when they're going to stop buying corporate bonds. I think there's going to be pressure on them for that. Still no music, huh? All right. All right. I know you guys got music now, but it's not how I wanted to broadcast it. Now I know you got music. Now, it's not about the music, John Appleseed. That music is what the Federal Reserve is playing right now. That's what JPOW is going to be coming from. If you can hear the music now, that means you're going to be able to hear JPOW. If you can't hear the music, you won't be able to hear JPOW. Alright, now it's coming through. It's not how I wanted to broadcast it, but it will work. JPOW has demonstrated over the last couple of years that he's willing to be a team player when it comes to the market. He's not willing to let the markets collapse on us. And I think that's great. I think that's great that he's been willing to do that. Just as importantly, though, eventually the United States need to start considering how much money it's been spending. How long are we going to watch this whole thing go? So far, SPY is coming off a little bit here. We're hovering around 420, which is a pretty lucky number, so I think that's great. I'll be interested to see how JPOW moves the market with his announcement. If I had to take a guess at what JPOW's portfolio looks like, I can more or less guarantee you that he's got a lot of SPY in it, because that's one of the only things he'd be allowed to purchase. And it's probably in a blind trust, too. Yeah, I hope this is helpful to somebody. I don't know where my dog is right now. I think she's under the bed. Yeah, no sweat, fatty. You know what stock I've been really enjoying lately has been Snap. I've got 10 poor man's covered calls on Snap. What do we got on Snap right now? Let's see. Whoa. Jesus, the market just collapsed. We got Snap under 60. Tesla just reversed, went negative again. SPY just completely tanked. Triple Q tanked. Thanks, JPOW. Jesus. Ay. Alright. It's really not what I was hoping for here. Well, at least my EWZ straddle is probably looking pretty good. I got a straddle at the $40 strike, so I'm sure that's looking lovely. Mara, coin, yeesh. I hope he's got some good intro music. What's AMC doing? I know somebody got wiped out today. FOMOing in yesterday. AMC is down 10%, but it's holding strong. It hasn't lost anymore since about 10 a.m., so that's pretty good. All things considered, that's not too bad. Hey, Casper, congratulations, man. That's fantastic. 450 AMC calls. Jeez. That's almost like when I had my GameStop calls at $3 strike. They would have expired by now, but I could have just as easily rolled them. Yeah, we're going to need something real good out of JPOW after this, because I'm watching the market tank right now. I'm not feeling too great about it. Now, on the positive side, if you have covered calls that are in the money right now, this is a great opportunity to get out of those covered calls. Maybe roll down and out, or just out. With Snap right now, I've got 10 poor man's covered calls. I've got my leaps at the $50 strike, and I've been selling short calls about 2 to 4 weeks at a time at strikes between 60 and 65. So those right now are looking real good. I'm able to pull that money in, reinvest it into shares, and I've got 2 years left on those leaps. So I'm not worried at all about the short term. XLF is pumping according to Wall Street Meet. That's good. I got 100 shares of XLF. The financials. Yep, financials just burst. Did some news happen in the last... That looks like almost exactly 2 p.m. East Coast time. Everything just flew. No explanation why. It just did. I didn't see any news yet. Casper, the next Dankest trade series is, I got half the script written, but I got another video coming out right after this. I'm going to publish it. It's uploaded now. It's going to be a relook of the wheel strategy, how we can get more out of it. I notice a lot of common mistakes people make when they're trading the wheel. I want to revisit the wheel with this video, try to correct some of those errors I see people making. Your boy Elias has a ton of Bitcoin puts. What are you trading that on? You trading that on Ledger X? They released the statement at 2. Okay, so what we're going to be seeing here is the speech by JPOW. But they already have a statement, huh? Alright, somebody fill me in, because I'm not about to go look right now. I'm live streaming. Somebody let me know what they got going for us. Five minutes until JPOW joins us. Yeah, this ought to be a good one. Who's that who just said there? Phil Simmons. He feels like a degenerate trading meme stocks while he's interning at an investment firm. Background music's too loud. Alright, I'll turn it down for now. I'll turn it down just a little bit. And then once JPOW comes speaking, I'll turn it back up so we can hear him. Gabriel Cordozo is asking, yeah, thank you, Hopped. Please do. Hey, I'm trying to get to 100,000 subscribers so I can make this into a real full-time work. So hook me up with some likes and get this thing spread out. The more the merrier. Once I can quit my job, that means a lot more videos. But we're not there yet. So Fed suggests rate hikes by the end of 2023. Okay, that should not be a surprise. I mean, I don't think the statement was even released when I first said it. I don't think we should expect them to raise rates. But we should. Did they give any information about when we should expect them to stop buying bonds, corporate bonds? That would be the most interesting. 2 interest rate hikes in 2023. Okay, that's fine with me. I mean, by then we should be fully back on our feet. It's the middle of 2021 right now. We've got a whole year left, or a whole 18 months left, before we even get to 2023, let alone the amount of time it takes them to start raising rates. Alpac is asking, what are your thoughts on water scarcity being a future play? Okay, that's a great question. Now, water scarcity, I don't know. Is it that scarce? I mean, I know people are buying water, like reservoirs. I don't know if we're at the point where we need to worry about scarcity at like a macroeconomic level. I know a company used to be called Aqua America. I think now it's called New Jersey Resources. That's a good one. My grandfather owned a bunch of them, which we then inherited. And Austin Jones said, you still have your Coinbase position? Yes, I do. I'm a proud bag holder of Coinbase. I bought in at, I think my average price is about $370. And I've been selling covered calls ever since. So we're getting a couple $100 a month there, $300 or $400. It's all right. Elias made 4 times his money by using the wheel strategy. Congratulations. All right, Weeaboo Barco gives us great information here. He says that in the Federal Reserve, and Cheng Chuck is corroborating this, the Fed reiterated its commitment to purchase assets, which is absorbing about $120 billion a month in assets. You know what? They're going to make money, honestly. The Fed is going to make money off of this. Hey, Triple Z says, Mikey, keep up the great work. And SPY shaking out of the paper-handed sissies. Yes, I agree with you, Triple Z. I don't even want to know how much money I lost today. And thank you very much for the super chat. I appreciate it. SPY, what is SPY doing in the last couple of minutes? Are we bouncing back? It looks like there's demand for shares at the lower level around the 420 price. I think that's great. I've got leaps on SPY. They're up over 100%. I got leaps at the 250 strike. They were slightly in the money when I bought them. Now they're quite deep in the money. Gun Quickie says, fresh water for farmland is hella scarce. It's not the water technically, it's the rights to drill wells into the water sources. If it's going to be like that, if that's the way our water is being treated, I don't think we need to worry about stocks for water. I think we need to go and seize the means. Say what, you start messing with my food prices because we can't get enough food because we don't have the rights to drill for water, we're about to go seize the means. We got a whole army of Theta Gang. I even know people out in Texas. Just drive up north. They've got guns. They're ready for this. We're going to go seize the means if they start doing us like that when it comes to our water supply. Adam Gillies is all in on Palantir PMCCs, working well today. All right, congrats. I love the PMCC. If you guys haven't used that strategy, you don't know about that strategy yet, get on board with it. Learn how to use leaps, and then start selling short calls against those leaps. Just do it intelligently. I've got videos on them. Other people have videos on those too. If you learn the PMCC, you can start trading covered calls with a lot less money than you think you would need to wheel something. Austin Jones says, thoughts on how Wall Street Bets keeps pumping and dumping random less than $2 billion market cap stocks? You know, if you had asked me this yesterday, I'd say it was one of the worst things that could have happened here. You know, what is happening to our market? But I had that live stream with Tom Sosnoff, and I asked him about this, and he made a really, really good argument. He said that at least people are investing. They might not be investing intelligently. They might not be learning anything with the way they're investing. But at least they're getting involved in the market, and that's worth something. You've got a lot more retail buyers just joining the market. So I think a lot of these guys are going to get blown out, and I'm okay with that because everybody pays their debts in the beginning. Pays their dues, rather. Oh, here we go. All right, tell me if you can hear this, okay?
Good afternoon.
Yeah, that sounds ugly on my
end.
end.
At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress
Still sounds
has
like
given
shit.
us: maximum employment and price stability. Today, the Federal Open Market Committee kept interest rates near zero and maintained our asset purchases.
Okay, that's good.
These measures, along with our strong guidance on interest rates,
That's his microphone that sounds like shit.
will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. Widespread vaccinations, along with unprecedented fiscal policy actions,
Thank you, Calamitous.
are also providing strong support to the recovery. Indicators of economic activity and employment have continued to strengthen, and real GDP this year appears to be on track to post its fastest rate of increase in decades.
Good.
Much of this rapid growth reflects the continued bounce back in activity from depressed levels. The sectors most adversely affected by the pandemic remain weak, but have shown improvement. Household spending is rising at a rapid pace, boosted by the ongoing reopening of the economy, fiscal support, and accommodative financial conditions. The housing sector is strong, and business investment is increasing at a solid pace.
Bouncing back from the pandemic.
In some industries, near-term supply constraints are restraining activity. Forecasts from FOMC participants for economic growth this year have been revised up since our March summary of economic projections. Even so, the recovery is incomplete, and risks to the economic outlook remain.
That looks fucking terrible.
As with overall economic activity, conditions in the labor market have continued to improve, although the pace of improvement has been uneven. Employment rose 419,000 per month on average in April and May, with the leisure and hospitality sector continuing to post notable gains. Employment in this sector and the economy as a whole remains well below pre-pandemic levels. The unemployment rate remained elevated in May at 5.8%.
Oh shit, you guys
and
don't have the
this figure
video.
understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving
Sometimes
needs,
it happens if you click
ongoing
off the window.
fears of the virus, and unemployment insurance payments, appear to be weighing on employment growth. These factors should wane in coming months against a backdrop of rising vaccinations, leading to more rapid gains in employment. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate standing at 4.5% at the end of this year, and declining to 3.5% by the end of 2023.
That still looks like shit.
The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. Inflation has increased notably in recent months. The 12-month change in PCE prices was 3.6% in April, and will likely remain elevated in coming months before moderating. Part of the increase reflects the very low readings from early in the pandemic falling out of the calculation, as well as the pass-through of past increases in oil prices to consumer energy prices. Beyond these effects, we are also seeing upward pressure on prices from the rebound in spending as the economy continues to reopen, particularly as supply bottlenecks have limited how quickly production in some sectors can respond in the near term.
Like lumber.
These bottleneck effects have been larger than anticipated, and FOMC participants have revised up their projections for inflation, notably for this year. As these transitory supply effects abate, inflation is expected to drop back toward our longer-run goal, and the median inflation projection falls from 3.4% this year to 2.1% next year and 2.2% in 2023. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic.
Are we still using like
As the
old
reopening
projections?
continues, shifts in demand can be large and rapid, and bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust, raising the possibility that inflation could turn out to be higher and more persistent than we expect. Our new framework for monetary policy emphasizes the importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal.
Maximum employment
Indicators
goal.
of longer-term inflation expectations have generally reversed the declines seen earlier in the pandemic and have moved into a range that appears broadly consistent with our longer-run inflation goal of 2%. If we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal, we'd be prepared to adjust the stance of monetary policy.
Yeah, no shit.
The pandemic continues to pose risks to the economic outlook. Progress on vaccinations has limited the spread of
JPOW's got
COVID-19
COVID.
and will likely continue to reduce the effects of the public health crisis on the economy. However, the pace of vaccinations has slowed, and new strains of the virus remain a risk. Continued progress on vaccinations will support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment.
This really sounds like the fireside chats with FDR.
Along with our responsibilities to promote the stability of the financial system. As the committee reiterated in today's policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%.
Okay.
We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment.
What is maximum employment? Isn't that 5%?
And is on track to moderately exceed 2% for some time. As is evident in the SEP, many participants forecast that these favorable economic conditions will be met somewhat sooner than previously projected. The median projection for the appropriate level of the federal funds rate now lies above the effective lower bound in 2023.
This is still a pretty dovish policy.
Of course, these projections do not represent a committee decision.
That projection
or plan,
is,
and no one knows with any certainty where the economy will be
pretty loving
a couple
for the
of years
market.
from now. More important than any forecast is the fact that whenever liftoff comes, policy will remain highly accommodative.
He just said we're going to the moon.
Reaching the conditions for liftoff will mainly signal that the recovery is strong and no longer requires holding rates near zero. In addition, we are continuing to increase our holdings of Treasury securities by at least $80 billion per month, and of agency mortgage-backed securities by at least $40 billion per month, until substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since March 2020 has materially eased financial conditions and is providing substantial support to the economy. At our meeting that concluded earlier today, the committee had a discussion on the progress made toward our goals since the committee adopted its asset purchase guidance last December. While reaching the standard of substantial further progress is still a ways off, participants expect that progress will continue. In coming meetings, the committee will continue to assess the economy's progress toward our goals.
He said liftoff.
As we have said,
I want him to say, like,
we will provide advance
and
notice
GameStop
before
to the moon.
announcing any decision to make changes to our purchases. On a final note, we made a technical adjustment today to the Federal Reserve's administered rates. The IOER and overnight RRP rates were adjusted upward by 5 basis points in order to keep the federal funds rate well within the target range and to support smooth functioning in money markets. This technical adjustment has no bearing on the appropriate path for the federal funds rate or stance of monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you. I look forward to your questions.
Oh, good. Okay, thank you.
Mr. Chair. First, we'll go to Rachel Siegel, The Washington Post.
All right.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm wondering if you can walk us through expectations you have, specifically when it comes to the labor market going into 2023. And I'm curious about people who may have left the labor market, who have yet to come back, or who may face issues with childcare, perhaps they've retired early. Any barriers that you see keeping people from the labor market as you consider full employment?
She's asking a good question. Are we going to expect more people to return to the labor market and affect unemployment?
So I would say if you look at the labor market and you look at the demand for workers and the level of job creation and think ahead, I think it's clear, and I am confident that we are on a path to a very strong labor market. A labor market that shows low unemployment, high participation, rising wages for people across the spectrum. I mean, I think that's shown in our projections. It's shown in outside projections. And if you look through the current time frame and think 1 and 2 years out, we're going to be looking at a very, very strong labor market. In terms of exactly what that means, we'll have to see how things evolve. I think we learned during the course of the last very long expansion, the longest in our history, that labor supply during a long expansion can exceed expectations, can move above its estimated trend. And I have no reason to think that that won't happen again. At the same time, we have seen, in terms of participation, we've seen a significant number of people retire. And so we don't actually know exactly what labor force participation
He's kind
will
of
be,
right, but a lot of people
as we go
retired
forward,
because
I
of
would tend
GameStop and AMC.
to look at it and think that it can return to high levels.
Those people aren't
although
coming
it may
back to
take
the
some
market.
time to do that.
The
But
labor
overall,
market,
this is going to be a very strong labor market. In terms of the near term, you ask as well. So we see a couple of things, a few things that seem likely to be holding back labor supply. There are very large amounts of job openings, and there are a very large number of people
saved one,
who
you're
are
correct.
unemployed. And the pace of
Nobody's going to go back to work right now
filling
for
those
$7
jobs
an hour.
is somehow feels slower than it might
You can
be. So I
make
point
more
to a
money
number of
trading
things.
stocks on
The
Robinhood
first
than
of
that.
which is just that most of the
You want me to drag the
act
chart
of sort
over?
of going back to one's old job, that's kind of already happened. So this is a question of people finding a new job. And that's just a process that takes longer. There may be something of a speed limit on it. You've got to find a job where your skills match.
All right, I'm moving the thing
what,
over, so it's all like messed up
what the
right now.
employer wants. It's got to be in the right area. There's just a lot that goes into the function of finding a job. So that's sort of a natural thing. In addition, I would say that
All right,
we
there you
look
go.
at, for example, a significant number of people still say that they're concerned about going back to work in jobs where there's a lot of public facing because of COVID. So that's clearly
Because
holding
they
back
pay
some people,
$7 an
and
hour.
That should diminish as vaccinations
You can make more money on OnlyFans.
There's also the question of childcare. Many are engaged in caretaking, and as schools reopen and childcare daycare centers open in the fall, or not in the fall, then we should see that supporting labor force participation by caretakers. Finally, unemployment insurance for something like 15 million people will either end or be diminished as we move through the summer and into the fall by the end of September. And I'd like some that may also encourage some to go back in and take jobs. So you would think that would add to an increase in job creation as well. So you put all those together, I would expect that we would see strong job creation building up over the summer and going into the fall. I will also say, though, the last thing I'll say is this is an extraordinarily unusual time, and we really don't have a template or any experience of a situation like this, and so I think we have to be humble
since
about
the
our
speech
ability
started,
to understand the data.
we've
It's
lost
not a time to
all
try
of
to reach
June's
hard
gains
conclusions
are gone.
about the labor market, about inflation, about the path of policy. We need to see more data. We need to be a little bit patient, and I do think, though, that we'll be seeing some things coming up in coming months that will inform our thinking.
All right. I mean, he is partially right, but I think we're ignoring the fact that you can make money in so many more ways than just going back to Walgreens, You can make more working from home.
The medium forecast on inflation seems to assume a pretty tame outlook for the rest of the year. As you know, the 3-month annualized rate for the past 3 months was, I think, 8.4% in the CPI. And I'm just wondering sort of how much longer we can sustain those kinds of rates before you would get nervous. Thanks.
So, inflation has come in above expectations over the last few months. But if you look behind the headline numbers, you'll see that the incoming data are consistent with the view that the prices that are driving that higher inflation are from categories that are being directly affected by the recovery from the pandemic and the reopening of the economy. So, for example, the experience with lumber prices is illustrative of this. The thought is that prices like that have moved up really quickly because of the shortages and bottlenecks and the like, they should stop going up, and at some point they in some cases should actually go down. And we did see that in the case of lumber. Another example
Muff and I haven't even started the next 3K
is
yet.
prices for used cars, which accounted for more than a third of the total increase in core inflation. Used car prices are going up because of sort of a perfect storm of very strong demand and limited supply. It's going up at just an amazing annual rate. But we do think that it makes sense that that would stop, and that in fact it would reverse over time. So we think we'll be seeing some of that.
Thank you,
When will
Haupt.
we be seeing it? We're not sure. That narrative still seems quite likely to prove correct, though.
He's
although,
talking about
as I
commodity
pointed out at the
shortages.
last press
I think
conference,
the most important commodity right now
the
is
timing of
semiconductors.
that
It's not exactly a
is
commodity,
pretty uncertain.
but it's
and
a
so
really,
are
really
the
important part of the
effects in
supply
near term.
chain.
But over time,
I think that's what we
it
need.
seems likely that these very specific things that are driving up inflation will be temporary.
Yeah.
And we'll be on. We're going to be looking. We'll be looking at the monthly pricing data. I'll also say that the labor market is going to be important both for the maximum employment goal, but also for inflation. And we'll be looking at that. And as I mentioned, we expect, and I expect, that we'll see increases in supply over coming months as the factors that we believe have been suppressing supply abate, wane, move down.
Let's get some more semiconductor fab
I can't
plants.
give you an exact
That'd be
number
real
or an
good.
exact time, but I would say that we do expect inflation to move down. If you look at the forecasts for 2021 and 2022 and 2023 among my colleagues on the Federal Open Market Committee, you'll see that people do expect inflation to move down meaningfully toward our goal. And I think the full range of inflation projections for 2023, it falls between 2 and 2.3%, which is consistent with
They're talking about 2023.
with our
He just gave
goals.
us the green light for the next 2 years.
Thank you. Now we'll go to Elon Mui at CNBC.
Hi,
JPOW,
thank you,
how
Chair
woke
Powell,
are you?
for doing this. My question for you is that you mentioned that your colleagues did have a discussion about the progress that you're making
She looks
toward
woke.
your goals in order to consider tapering your asset purchases. In that discussion, you said that you haven't made substantial progress yet, but that you expect to continue to make progress. In that discussion, did you guys talk about a timeline for when you expect to see that progress be made and when you might consider starting to reduce those purchases?
Good question.
So I expect that we'll be able to say more about timing as we see more data. Basically, there's not a lot of more light I can shed on that. But you can think of this meeting that we had as the talking about meeting, if you like. And I now suggest that we retire that term, which has served its purpose well, I think. So committee participants were of the view that since we adopted that guidance in December, the economy has clearly made progress, although we are still a ways from our goal of substantial further progress. Participants expect continued progress ahead toward that objective. And assuming that is the case, it will be appropriate to consider announcing a plan for reducing our asset purchases at a future meeting. So
He's just reading
at
that
coming
one.
meetings, the
He's
committee
got
will
no
continue
answer.
to assess the economy's progress toward our goals, and will give advance notice before announcing any decision. The timing, of course, Elon, will depend on the pace of that progress and not on any calendar.
So no plans yet. Hey, another green light.
Thank you. Now we'll go to Chris Rugaber, AP.
All right, thank you. Well, you mentioned, let me ask about inflation expectations. You said they were, I think you mentioned in your opening statement that you saw them as within target. Does that mean that some of the shorter term measures we've seen out there, such as the New York Federal Reserve's 3-year outlook, which jumped a bit, should those sort of be dismissed?
Did he just say
And
jump
are
a
we only
bitch?
looking at longer term inflation expectations, and would you describe those as still well anchored at this point? And on a related note, would the Fed consider publishing its index of common inflation expectations on a monthly basis? Thank you.
So we do tend to look at the longer term inflation expectations, because that's really, we think, what matters for inflation. The shorter term ones do tend to move around based on, for example, gasoline prices. So you'll see, if gasoline prices were to spike, you'll see the shorter term inflation expectation measures, particularly the surveys, move up. And that's maybe not a good
jump a
signal
bitch.
for future inflation if gas happens to spike and then go back down again. Yes, I think if you look at the broad range of longer term inflation expectations, they've moved up they moved down at the beginning of the pandemic, sort of further exacerbating concerns that we might find ourselves where, for example, the ECB and the Bank of Japan have been, where you have expectations and inflation itself
Don't
sliding
say negative
down,
interest
and
rates. I swear to
you have
God,
a really hard
JPOW.
time stopping
Don't
that
you fucking do
process
it.
once it begins. So that was a concern.
Don't you do it.
So it's good actually to see longer-term inflation expectations move back up to a range. It's a range that's consistent with what our objectives are. These are not precise measures, and they contain risk premiums of various kinds, and that's why we look at a broad range of them and tend to look at the movement of that broad range of indicators, which are from surveys of economists, surveys of the public, and also market-based. It's
However high
as I'm
AMC
sure you know.
goes is going to drive our
We look at
decision.
that and we see them back in the range where they were, and by the way, they've been broadly higher than that, somewhat modestly higher than that, not so many years ago at a time when inflation was still
Honestly,
anchored
this feels
and,
to me like a
at around
call
2%
buying
or maybe
opportunity.
even a little bit below. So the answer is yes, I think they are.
This is an opportunity
anchored,
to
and they're
buy
in a
the
good
dip.
place right now. It's gratifying to see them having moved up off of their pandemic lows. And as you know, it's fundamental in our framework, our new framework, to assure that longer-term inflation expectations are anchored at a place that is consistent with our goal. We think that's an important reason. If inflation expectations are not anchored at a place that's consistent with your goal, it's not clear why you would expect to hit your goal over the longer term. So it's
Profound, JPOW. Thank you.
Okay, now we'll go to James Politi with the FT.
Chair Powell. Hi, thanks, Chair Powell. Your economic projections today forecast 7% growth in 2022, unemployment of 4.5%, and core inflation of 3%. If those conditions are achieved by the end of the year, would that constitute substantial further progress in your mind? And kind of more broadly, when you look at the sort of median forecast for interest rates in 2023 showing not one but two interest rate increases at the time, is this kind of, can you describe the sort of tone of the discussion in the committee, and are we really moving towards sort of
what is this guy asking?
Post-pandemic stance? Is there greater confidence that the recovery will be a full recovery sooner than expected?
First question, the judgment of when we have arrived at substantial further progress is one that the committee will make, and it would not be appropriate for me to lay out particular numbers that do or do not qualify. That is the process that we're beginning now. At the next meeting, we will begin meeting by meeting to assess that progress and talk about what we think we're seeing. And just do all of the things that you do.
This is like
to
the same question the last person asked.
Around the process of deciding whether and how to adjust the pace and composition of asset purchases. In terms of the two hikes, so let me say a couple things. First of all, not for the first time about the dot plot. These are, of course, individual projections. They're not a committee forecast. They're not a plan.
Mason, thank you for the super chat.
We did not
I'm
actually
considering
have a discussion
put credit spreads on
of whether
AMC.
liftoff
In
is
fact, I
appropriate
sold
in any
puts
particular year,
last
because
week
discussing
and let them
liftoff
expire.
now would be highly premature. It wouldn't make any sense.
I'm not buying calls. I'm selling puts.
If you look at the transcripts from 5 years ago, you'll see that sometimes people mention their rate path in their interventions. Often they don't. And the last thing to say is the dots are not a great forecaster of future rate moves, and that's not because it's just because it's so highly uncertain. There is no great forecaster of future dots. So dots to be taken with a big grain of salt. However, so let me talk about this meeting. The committee spelled out, as you know, in our FOMC statements, the conditions that it expects to see before an adjustment in the target range is made. And it's outcome-based, it's not time-based, and as I mentioned, it's labor market conditions consistent with maximum employment, inflation at 2%, and on track to exceed 2%.
I mean, that's a good answer right there. 5% unemployment, 2% inflation is the goal that we're looking for.
Honestly, the
At that point, we start adjusting.
Away from the SEP is that participants, many participants, are more comfortable that the economic conditions in the committee's forward guidance will be met somewhat sooner than previously anticipated. And that would be a welcome development. If such outcomes materialize, it means the economy will have made faster progress toward our goals.
Retro Mags, this is a buying opportunity.
Rate increases are really not at all the focus of the committee. The focus of the committee is the current state of the economy, but in terms of our tools, it's about asset purchases. That's what we're thinking about. Liftoff is well into the future. The conditions for liftoff, we're very far from maximum employment, for example.
Liftoff.
It's
there it is. We're going to the moon, guys.
So the near-term thing is really, the near-term discussion that will begin is really about the path of asset purchases. And as I mentioned, we had a discussion about that today and expect to, at future meetings, continue to think about our progress.
Thank you. We'll go to Nancy Marshall-Genzer from Marketplace.
Chair Powell, continuing in that vein, when you're ready, how will you go about signaling the start of tapering when you do decide to do that?
So our intention for this process is that it will be orderly, methodical, and transparent.
Okay.
And I can just tell you, we see real value in communicating well in advance what our thinking is, and we'll try to be clear. And as I mentioned, we'll give advance notice before announcing a decision to taper. And so all I can say is that we think it's important. We think where the balance sheet's concerned, a lot of notice, as much transparency as we can give, and as far in advance as we can, to give people a chance to adjust their expectations.
AKA buy
puts. And, we expect to be in that business until we reach substantial further progress, and then have a decision. Again, I have nothing further on time. It wouldn't be appropriate to say we're going to have to see more data. We're a ways away from substantial further progress.
Don't worry, guys. I'll let you know when we're going to start tapering so that you can buy puts in advance.
So you can't say generally how far in advance you would signal.
Again, as we approach that goal, we'll provide as much clarity as we can.
Great, thank you. Going to Craig Torres at Bloomberg.
She's doing this right now.
Craig Torres at Bloomberg. If I were a businessman looking at the forecast today, I would ask how and when the Fed seeks to achieve an average of 2% inflation. In other words, does the FOMC have a look-back period, or does it plan to suppress inflation in outer years? Because over the next 3 years, you're going to be above inflation. So what is your look-back period? Does the committee have one? And if not, why not? And if they don't, why isn't this just flexible inflation targeting without an average in a range of 2 to 2.25%? Thanks.
So as part of our year-and-a-half-long process, the review that we did.
Thanks, Cocoponics. Glad you enjoyed
that with the new
Good luck with the farm
goals and monetary policy strategy. We look carefully at the idea. We've all read all of the literature around different formulas for makeup and things like that. And
hey, what's up, Kunal?
And I strongly agree that it's not wise to wed yourself to a particular formulation of that. So we did adopt a discretionary. There's an element of discretion in it. It says that we will seek inflation that runs moderately above 2% for some time. And it's meant to create a broad sense that we want inflation to average 2% over time. But
we'll take 1 versus 3.
Under the old
average amount at 2.
Under the old framework, what was happening was 2% was a ceiling, because all of the errors were below. You were always getting back to 2%, so you were bouncing back and forth between 1.5 and 2, and we wanted them to be centered around 2. So that's the approach that we're taking. And you're right, it's not a formula-like approach. We were clear on that when we announced the framework. Was there another part of your question, Craig?
I went part-time, Kunal. That was my step. That's why there's more videos.
That pretty much answers it, Chair.
I'm taking off 1 extra week out of every 5. So I work.
Thank you. Now we'll go to Michael Derby.
3 weeks out of every 6.
Thanks for taking my question. So I wanted to ask you about the reverse repo usage that we've seen lately. I was curious if you are at all concerned about the level of money flowing into the reverse repo facility? And do you believe that the changes in the Fed's rate control toolkit today will have any impact on that? And then in a related question, do you think that Fed asset purchases are taking too many safe assets out of the market right now and creating maybe some dislocations in the money markets?
Finally, a decent question.
So on the facility, we think it's doing its job. We think it's doing the reverse repo facility is doing what it's supposed to do, which is to provide a floor under money market rates and keep the federal funds rate well within its range. So we're not concerned with it. It's doing. You have an unusual situation where the Treasury General account is shrinking and bill supply is shrinking, and so there's downward pressure. We're buying assets. There's downward pressure on short-term rates, and that facility is doing what we think it's supposed to do. Sorry, your second question was again?
Yeah, I mean, the change in the rate control toolkit.
I'm about to pin my recommendation right now.
Do you think that will reduce the amount of money coming into reverse repos? Will that have any impact on money market conditions that, beyond the Fed funds rate setting?
That's what we need to do on this
dip. It could have some impact. I think we'll have to see empirically, but
the dip.
It's designed to keep the federal funds rate within the range. And
now, everything he's saying right now is exactly what we should have expected. So seeing these stocks decrease,
below, as it relates to
SPY wiping out all of its gains for June so far, I see this as a buying opportunity.
Do you think it will lower uptake on the reverse
I think this is a great buying opportunity
or that's just not even really a focus of what
I don't have a whole lot of cash left,
honestly,
but I think this would be a good chance to sell some put credit spreads
we'll have to see.
at the money.
It's possible that would not be the case. That's going to be an empirical question.
Okay, cool. Thank you.
I will go to Gina Smialik, The New York Times.
Hey, JPOW. Thank you for taking our questions. I was wondering.
I've been waiting to hear for this one. She better not be annoying.
On your response to Rachel at the very beginning, and talk a little bit about how we should understand what full employment means in a world that, as you mentioned, is pretty roiled. All the data has been pretty roiled by the pandemic, and we're not really sure where EPOP is going to settle in. We're not sure where participation is going to settle in, and wages are already looking, decent. So I guess I wonder what full employment means in this context, and sort of how you're thinking about those wage data.
5%.
Yeah, as you well know, there isn't one indicator we can look to, and there's no one number that we can therefore point to. We look at a range of indicators, and it's a very broad range. You can count to a high number just quickly, but certainly it will include things like unemployment and participation and wages and many different flavors of that. So how do we think about it? A couple things. We're all going to be informed by what we saw in the last cycle, which was labor supply.
Yeah, if he asks, hey, what's your OnlyFans? I would fucking die right now.
Now, that hadn't happened in many other cycles, but this was a very long cycle. So we're going to have to be alert to see whether that can happen again. It's a different economy. We have had a slew of retirements, and that may weigh on participation. That effect, though, should wear off in a few years, and as you move through that window, because people would have retired anyway, and you'll be back where you would have been. So I think I think the lesson number one is just to be careful about assessing maximum employment, and I think during the last cycle there were waves of concern that we were reaching full employment as early, as 2012 when I arrived at the Fed, and 8 years later, we were still creating jobs, and
interest rates are going to stay the same until about 2023.
So we're all going to be informed by that. At the same time, we understand this is a different economy. Mm-hmm. The demographics people are getting older, and
I think we should expect the same type of move we had in 2008, where by the time people were coming back into the market, they would have retired anyway.
So we have to be sensible about what can be done. But I think we're going to lean into that and be optimistic. You asked about wages. We're seeing wage increases. That's sort of a natural thing to be seeing in a strong economy. And what we're seeing is that we don't see anything that's troubling in the sense of what would be troubling would be, very wide across the economy, wages at unsustainable levels without high inflation. In other words, wages in excess of productivity and inflation by a meaningful amount broadly across the economy.
That's not going to happen because we'll have automation.
Sort of forcing companies to keep raising prices and getting into a wage price cycle. That's the old formula for one of the old formulas for having high inflation. We don't see anything like that now. We do see high wages. We see them for people who are mostly new, entering into new jobs, many of them in low-skilled jobs, and but we do think you've got a thing in the labor market right now where supply and demand are just not matched up well, and we think it's a flexible economy and it will clear. There will be a level at which supply and demand meet, and we think that'll be happening in coming months. So, the last thing I'll say is, again, if you look at the forecasts, we're going to be in a very strong labor market pretty quickly here. There's still a big group of unemployed people, and we're not going to forget about them. We're going to do everything we can to get people back into work and give them the chance to work. But there's every reason to think that we'll be in a labor market with very attractive numbers, with low unemployment, high participation, and rising wages across the spectrum. So that's a little bit how we're looking at the labor market.
The day's going to come where we need to start considering the people that are like YouTubers, Twitch, OnlyFans, all that stuff as employed.
Hi, I
mean, it's formally considered self-employed, but nobody's checking to see if you're making money that way.
Leverage ratio right now. Is the Fed still thinking about ways to permanently adjust this to account for the high growth in deposits? And do you ultimately believe a permanent fix is needed? And any information on the timing around that would be helpful.
I can say is we're working on it. Don't have anything to share with you in terms of the particulars or the timing right now, unfortunately, but we've always, our position has been for a long time, and it is now, that we like the leverage ratio to be a backstop to risk-based capital requirements. When leverage requirements are binding, it does skew incentives for firms to substitute low-risk assets for high-risk ones. It's a straightforward thing.
Tesla's up over 1%.
And because of the substantial increase in reserves, treasuries, and other safe assets,
Wish
the
is
banking
coming
system,
back up.
the SLR, is rapidly ceasing to be the intended backstop for our big firms that we want it to be. So we do think it's appropriate to consider.
This dip is getting bought, guys.
Ways to adapt it to this new high reserves environment, and we're looking hard at the issue. We would also, just to be really clear, we will take whatever actions are necessary to assure that any changes we do make or recommend do not erode the overall strength of bank capital requirements. Oh, sorry, I can't give you any more. It's just something we're working on.
A weak-ass microphone.
Thank you. Now we'll go to Anakin Tappa at CNN Business.
Frank, I wouldn't be feeling those VIX puts right now, personally.
Thanks for taking my question.
I think this dip is getting
Chairman
bought
Powell,
up.
The price jumps we've seen in some raw materials, lumber, for example, you mentioned it earlier, seem to be easing, and it looks like we're at the beginning of suppliers catching up with demand. But I wonder if you're worried at all if we're going to end up with excess supply immediately after those shortages were off, and if we just continue this mismatch as we're recovering and getting out of the pandemic economy. And I wonder how that would affect the Fed's outlook at all.
Well, that is really not the problem we're having right now. But actually, people who work in commodity industries are very focused on that, because they know that they don't want to build capacity and then find out that it's not necessary. So really, the problem now is
that extra supply is going to get bought up.
Demand is very, very strong. Incomes are high. People have money on their in the bank accounts. Demand for goods is extremely high, and it hasn't come down. We're seeing the service sector reopening, and so you're seeing prices are moving back up off their lows there. But in terms of overcorrecting, I think there is a possibility on the other side of this that inflation could actually be quite low going forward. But that's not really where our focus is right now. Our focus right now is
bullish. Yeah, you're right. They are.
We need to. Our expectation is that these
the fear and my bad.
These high inflation
yes,
readings that we're seeing now
hold the VIX puts
will start to abate, and that's what we think, and it'll be
my bad. I wasn't
like
paying
the
attention.
lumber experience, and like we expect the used car experience to be, with things like airplane tickets and hotels, which are the other two factors in the most recent CPI report that went up a lot. We expect that those prices will get back up to where they were, but there's no reason to think that they're going to keep going up a lot. Because
I think JPOW is right this time. I think as supply for commodities starts increasing again, they're going to get purchased up.
So
I don't think we're going to wind up with excess supply.
I think in terms of the timing and the effects on inflation in the near term, there's a lot of uncertainty. The overall story is one that we think is right, and we think the incoming data support it. And so do many forecasters. And if you look at the forecasts on the FOMC, you will see that as well. But we don't in any way dismiss the chance that it can work out that this goes on longer than expected, and the risk would be that over time it does begin to affect inflation expectations. And if we see inflation expectations and inflation or inflation moving up in a way that is really materially above what we would see as consistent with our goals, and persistently so, we wouldn't hesitate to use our tools to address that. Price stability is half of our mandate, and we would certainly do that. We do not expect that, though. That is not our base case, and in that we're joined by many other forecasters. But there's a lot to be humble about among forecasters. Forecasters have a lot to be humble about. It's a highly uncertain business, and we're very much attuned to the risks and watching the data carefully. In the meantime, I would say
I'm about to sell my covered calls on Snap.
There's so much uncertainty around this. It's
the
just
sell-off
a unique
is starting to go away.
situation that we need to see how things evolve in coming months.
Oh, good. I'm only down 4,000.
See how that story holds up and act accordingly.
Thank you. We'll go to Howard Schneider at Reuters.
Howard Schneider, Reuters. Thanks, Chair Powell, for taking this. I don't want to miss the moment here, and I noticed that in the statement you dropped the language saying that the pandemic is weighing on the economy. So is this the effective end, in your view, of the pandemic as a constraint on economic activity, even though it's still cited as a risk?
Selling my Snap, buying back my Snap covered call right now.
What you've seen with the pandemic is sharply declining cases, hospitalizations, and deaths, and that's great. And that should continue. But you also saw in the United Kingdom, which has, I think, at least as high, if not higher, vaccination rates, they've had an outbreak of the Delta variety, and it's causing them to have to react to that. So you're not out of the woods at this point, and it would be premature in my thinking, it would be premature to declare victory. Vaccination has a ways to go to get to levels. It would be good to see it get to a substantially higher level, and that can only help.
Closed my my Snap covered call. Gain is 96. I'm going to roll this one out. Sell a higher strike expiring further out in the future.
But you can expect us to drag our feet a little bit on that, because that's what you do with statement language. It's great to see the progress, but again, I would not declare victory yet. I would say
I bought to close my Snap covered call, and I'm going to sell a new covered call on Snap at a higher
who doesn't
strike.
Want to see that? And it appears to be safe, and I just would encourage people to continue to get vaccinated.
If I could follow up on that, if you view the statement in toto and the dots and the steps as well, do you think this is more a mark-to-market exercise around the improvement in health or around the inflation risks you see developing out there?
I think it's both. No, I think clearly since March, what's happened is people have grown more confident in these very strong outcomes that they'll be achieved. Very strong outcomes in the economy will be achieved. There's more grounds for confidence. We've seen growth come in higher than we expected. We've seen very strong labor demand.
All right, I'm selling a Snap 70 strike call,
above target, though. And
covered call,
even though
expiring July 23rd. I'm selling it for.
They do see inflation coming back down over 22 and 23 into.
I'm gonna sell it for $135.
Very consistent with our mandate. Nonetheless, the risk is something that can.
And I got 4 leaps on Snap that are still open.
About appropriate monetary policy.
This is a poor man's covered call, so I don't have shares. I have leaps.
I can't stand here and say exactly what was in all 18 people's minds, but that is something that I think can factor into things as well.
All right.
factor into our forecast as well.
Thank you, JPOW, for causing a dip. Give me an opportunity to get out.
Victoria Guida with Politico.
Hi, Chair Powell. I wanted to ask a little bit more about inflation to make sure I understand how you're thinking about this. So in the projections, inflation is expected to be high this year and then come back down next year, and then maybe start to rise a little bit again, enough for a liftoff in 2023. You know, I know that's obviously, take that with a grain of salt, but that would suggest that you all could theoretically see inflation sustainably staying above 2%. And so I guess my question is, what would be causing that inflation? What would be, because it seems like you all now see a situation in which inflation would be rising in a way that isn't caused by transitory factors in the next couple of years. So would that be the result of a tight labor market? Would that be because this whole situation has raised people's inflation expectations? How are you
tight labor market?
So what we're seeing in the near
supply
term,
shortages.
Again, our base case is that what we're seeing in the near term is principally associated with the reopening of the economy, and not with a tight labor market or tight resource constraints, really. But you're right. When you get to in the forecast, all of that, the supply and demand sides of the economy adapt. We have a very highly adapted, flexible economy, more so than most. And by 2023, those increases are really about rising resource utilization, or to put it a different way, low unemployment or high employment is a way to think about it. So that's what that's about. That's about the kind of broad inflationary pressure that results from a really strong expansion, tightening up resource utilization across the whole economy, and lifting up inflation. That's why you would see it then, because by then, in the forecast, and it's just a forecast, they're just individual forecasts. In people's forecasts, that's what's happening.
So the change of the projections reflect the fact that you all are more optimistic about the economic outlook, and not necessarily that you think that this will change the way people think about inflation.
Yeah, I think there may be an element of the latter as well, because inflation expectations have continued to move up. It's it's all in people's individual thinking, and you can't. It's hard to say. It's not something the committee debates. In terms
JPOW is starting to bore me.
What the outlook is for 2023.
I need more liftoff. I need more meme.
Speculating, which I shouldn't do, but I wouldn't surprise me if there's an element for some people in seeing the inflation performance that we've had, and thinking that I have more confidence that we could see inflation above 2%. That it may not be as hard to do that as we thought, and that inflation expectations may move up to a level. They were really at a level that was kind of a little below 2%. They might move up as a consequence of this, or as a consequence of the new framework. We did see inflation expectations moving up in the wake of the announcement of the framework, but we don't really know that. So ultimately, I think it's consistent with both those things.
Thank you.
What in God's name is Iris? Well, thank you.
Hi, thank you.
I have no idea what Iris is, though.
Chair Powell, I'm just looking at the forecast, and the one thing I just don't think it's been talked about all that much is how much the Fed thinks that the economy is going to slow next year. I mean, are we looking at a scenario of a slowing economy next year as with higher inflation? And what do you think about that?
We're looking at an economy that will not have the degree of fiscal support. The fiscal support in the forecasts is much less than it was this year. So,
Don't say
but
that.
You've still got a very strong growth, well above the longer run potential output of the
next year. We
economy.
will fuck your calls.
You've got growth meaningfully above that, and inflation is lower next year in all of our forecasts. I think the range of core PCE forecasts for next year is 1.7 to 2.5 in 2022, and 2 to 2.3 in 2023. So you're right. You're seeing. I can't remember the number, but it might be in the 3.5% growth for next year. That's a really good year.
That's really good.
Coming on the back of a 7% growth year.
Yeah,
that's a really good year. That's a year with a lot of momentum. That'll see, that'll cause significant job creation, and it will. I mean, we would take 3.5% We didn't have a 3.5% growth year. We didn't have a 3% growth year between the global financial crisis and the end of the expansion. So that would be a good year.
He does still have to weigh in, though. A lot of that is still leftover recovery.
Of, like stagflation.
We're not at baseline.
You're going to go from 7%
and then getting 3%
down.
on top of
that
it.
means the economy is really dropping in some way. We haven't seen that, right?
It's just economy's not the economy is still growing, and growing at a very healthy rate. Our estimate, different people have different estimates, but broadly speaking, economists think the economy has the potential to grow at around 2% per year. If you're growing above that, then the unemployment rate should be declining. People should be being pulled into the labor force. Wages should be going up. Lots of things should be happening. Businesses should be investing. So, I guess to answer your question in a different way, is there a risk that inflation will be higher than we think? Yes. As I said earlier, we don't have any certainty about the timing or the extent of these effects from reopening, and therefore we don't think that we think it's unlikely that they would materially affect the underlying inflation dynamics that the economy's had for a quarter of a century. The underlying forces around the globe that have created those dynamics are intact, and those are aging population, low productivity, globalization, all of those things that we think have really held down inflation. All that's out there still. When we get through this, we'll be facing those same forces. Nonetheless, is there a risk that inflation will remain higher than we thought? Yes, and if we see inflation moving above our goals in a time, to an extent, to a level or persistently enough, we would be prepared to use our tools to address that.
What tools does he have left?
Thank you. Going to Brian Chung with Yahoo.
Brian Chung, Yahoo Finance. On that point, you talked about maybe some of the more structural changes in that last answer with regards to productivity. I noted that the median projection for R-star, the longer-term interest rate, is still the same at 2.5%. But there's been some literature out there that maybe the COVID crisis could have actually changed some of the underlying fundamentals of the economy and maybe changed productivity, in addition to combine with demographic changes that have already been in effect to suggest that that longer-term neutral rate or R-star might be higher. What would the implications of that be for monetary policy? Do you think that maybe the Fed could have the possibility of underestimating the long-run neutral rate, and what might be the impact of that?
A higher neutral rate would mean that interest rates would run higher by that amount.
We got a good power hour here so far.
A good thing from the standpoint of the economy, because it would
yeah,
give
Tarker,
the Fed
I
more
use
room to cut rates.
RSI and MACD.
The problem with interest rates being close to the lower bound, of course, is that it really cuts into our ability to react to a downturn. For example, a pandemic. And if you look, for example, at the European Central Bank, their policy rate was well below zero when the pandemic hit. So we don't want to be in a place where we can't react. A higher neutral rate would be, from that narrow standpoint, would be a good thing for us. It would give us more room, and therefore then that would tend to result in better outcomes for the economy over time. You can't estimate it with great precision. I think we would be alert to, studying R-star is a whole industry unto itself, and I think we would be alert to factors that might raise R-star, the neutral rate of interest. And we try to keep up with that. And I think we're
right now the neutral rate of interest is like 1%, probably even lower than that. 0% interest is the new normal
right now that essentially could lead to higher productivity growth and higher R-star. We don't know which of those stories will come true, but I'll give you an example. It's just there are a lot of startups, a lot of early stage companies, and is that going to have that effect? We don't know, but we'll be watching those things carefully.
Great. Thank you. For the last question, we'll go to Michael McKee at Bloomberg TV.
Mr. Chairman, of course, you'll be shocked to learn that you have some critics on Wall Street, and I would like to paraphrase a couple of their criticisms.
He has no
and get
critics.
Your reaction to
we all
them.
love JPOW.
One is that the new policy framework is that you react to actual data and do not react to forecasts, yet the actual inflation data is coming in hot, and you're relying on the forecast that it will cool down. in order to make policy. I wanted to get your view on how you square that. Another is that you have a long runway, you've said, for tapering with announcements, but if the data keep coming in faster than expected, are you trapped by fear of a taper tantrum from advancing the time period at which you announce a taper? And finally, you've said the Fed knows how to combat inflation, but raising rates also slows the economy. And there's a concern that you might be sacrificing the economy if you wait too long and have to raise rates too quickly.
So that's a few questions there.
He's probably afraid of the taper tantrum
so let me
too.
Say first, I think people misinterpret the framework. I think that there's nothing wrong with the framework, and there's nothing in the framework that would in any way interfere with our ability to pursue our goals. That's for starters. All of our discussions and all of our thinking and planning are taking place in the context of our new framework. We're strongly committed to it. We think it's well suited to our goals, including in this unique time. And I think if you look at the forecasts that we written down, our committee is solidly behind them. The forecasts are all consistent with that. Your specific question, I guess, was will we be behind the curve? And that's not the situation we're facing at all. The situation that we addressed in our statement on longer run goals and monetary policy strategy was a situation in which employment was at very high levels, but inflation was low. And what we said was we wouldn't raise interest rates just because unemployment was low, employment was high, if there was no evidence of inflation or other troubling imbalances. So that's what we said. That is not at all the current situation. The current situation, we have many millions of people who are unemployed, and we have inflation running well above our target. The question we face with this inflation
is
nothing to do with our framework. It's a very difficult version of a standard a central banking question, and that is, how do you separate in inflation? How do you separate things that follow from broad upward price pressures from things that really are a function of sort of idiosyncratic factors due to particular things? I mean, a classic example was, to pick a narrow example, was the cell phone price war back in 2017. If you remember it, prices were incredibly low, and it held down core PCE by 0.3 or something for a year, and then it fell out.
I did not know about that.
And of course, it's not easy to tell in real time which is which, but that's the question you would face under really any framework. And we're trying to sort that out. I've tried to explain that today about how we think about that. And we do think that these are temporary factors and that they'll wane. We can't be absolutely certain about the timing of that, and we're prepared to use our tools as appropriate.
Isn't a lot of these inflationary factors just based off the fact that we had such a sharp decline in 2020 that any bounce back is going to have an overly exaggerated recovery?
We will taper when we feel that the economy has achieved substantial further progress, and we will communicate very carefully in advance on that. And that's what we're doing. That's what we're going to do, and we will follow through on that. There's no, we will do what we can to avoid a market reaction, but ultimately, when we achieve our macroeconomic goal, we will taper as appropriate. The third thing was, what was the third thing?
If you raise rates to control inflation, you also slow the economy, and the history of the Fed is that sometimes you go too far.
That's right, and we have to balance the two goals: maximum employment and price stability. Often they do pull in the same direction, of course. But when we raise interest rates to control inflation, there's no question that it has an effect on activity, and that's one of the channels through which we get to inflation. We don't think that we're in a situation like that right now.
Yeah,
we think
congratulations to whoever bought the dip.
From a deep hole.
It's coming back off a little bit, but that's a significant recovery so far.
To do with shutting down the economy. It turns out it's a heck of a lot easier to create demand than it is to bring supply back up to snuff. That's happening all over the world. There's no reason to think that process will last indefinitely. But we're gonna watch carefully to make sure that evolving inflation and our understanding
big recovery
of
on
what's
GameStop. It's back to pretty much even for the day.
And in the meantime, we'll conduct policy appropriately.
Thank you, Mr. Chair.
Thank you very much.
Oh, that's it. All right, pretty much wrapping it out here. All right, so what did we see? Well, first, we're back to sound, back to music. All right, so from what we saw there so far, JPOW has indicated there will be no change to interest rates, which is very good. They're looking at 2023 for the first opportunity to increase interest, so that's nice. And then they don't know when they're going to stop purchasing bonds, but they plan to tell us in advance so that we can switch to puts, basically. Now, I think that last guy was asking the right question there. What happens once you start buying bonds? It's a good question, and I think he's right. There is going to be a panic in the market, and people are going to sell. But, I mean, so far that doesn't look like they have any plans anytime soon to cut interest rates. And once they do it, I think we will see a sell. Not interest rates, rather, I'm sorry. To cut off the bond purchases. But it sounds like it'll be done in an incremental fashion. It's not going to be a cold turkey situation. And when that happens, it'll give us an opportunity to reformulate our portfolios. Maybe take on a more reserved stance. But JPOW has shown time and time again he's willing to be part of that plunge protection team. He doesn't want to see the market drop. Yeah, he knows there's about, I don't know, 200 million investors in the United States that are all counting on him to make sure that we don't crash. So I don't think he's going to make any moves that are going to absolutely destroy the whole bull market. He'd have to do things incrementally. Give the market an opportunity to adjust to the lack of bond purchases. And once interest rates do rise, honestly, it might end up being a good thing for a lot of people, because we need to get to the point where you can make we need that risk-free interest rate to increase. It'll have a little bit of a maneuver away from the high-growth stocks into something more reserved, but naturally, to have a healthy market, you can't just have 0% interest forever. And we especially can't have negative interest rates, which I think a lot of people were concerned about at one point, and probably still are. All right. Well, I guess that about wraps it up. So, I'll thank everybody for joining me. I'll cut this one off here. But this was fun doing a live stream like this. I'd like to do more live stream events when there's big news going on. I was hoping that JPOW would give us something a little bit more exciting. But he basically said, no change. Can everybody please stop asking me stupid questions? Because I've got other things I want to do today. But congratulations to those who bought the dip. We were saying it the whole time. I think a lot of people in here were in agreement. There was really no reason for the market to drop that much based on the fact that he said no change. It looks like the market's starting to come off again a little bit. That might just be people taking profits after buying the dip. If you had bought calls, right at the drop right there, expiring this week, you'd have been tripling your money if you bought at the money calls. So good for you guys that pulled that off. All I did here was I closed a covered call on Snap because it dropped pretty substantially during that hour. So I closed the covered call at the $60 strike that I've been dying to get out of. That was way too low. I think Snap is going to keep bouncing between like 60 and 65, maybe up towards 70 within the next 90 days. So I was happy to get out of that $60 covered call at a profit of $98. I'm going to do what I usually do, reinvest that right into shares, and then sell another covered call further out. So I sold the $70 covered call expiring in the middle of in the middle of July. Right now I've got 4 leaps naked on Snap. I'm going to try to cover those and pull some more cash, but I want to let this dip kind of play out. Once Snap starts getting up toward 61.5, 62, I'll start looking to get back out. It looks like Snap is at about 60.50 right now, 60.59, so that was a good close on my end. As far as more videos, because I see a couple of you guys are asking, am I planning on doing any more Dankus Trades videos again? Yeah, I am doing that. I have 4 out of 5 that I need for the next episode for the Dankus Trades. I gotta find a good one. I'm also in the middle of a script right now for a mini-series on the whole deep fucking value saga the whole way through, from start to finish, like October until where we are today. Of course, it's not completely finished yet, but I want to give a realistic perspective on what this whole fiasco actually is. I don't think it's the war against hedge funds that a lot of people are calling it. But I think there is a lot of exciting stuff going on here, and I want to cover it with my realistic look. There is going to be a new video out today. It's going to be a revisit of the wheel strategy, because I think a lot of people have made a lot of money off that strategy, but there's some people that are using it incorrectly. And I've made mistakes with the wheel also, and I want to share those lessons learned over the past year and a half since I published that initial video on the wheel. And it's still the strategy I get the most questions about. Everybody still asks me about the wheel all the time. And having this video in addition to the original wheel one, I think will add some perspective to it, help people learn some of the lessons that I also learned over the past year and a half that I've been wheeling. I've been wheeling a lot longer than that, but you know, you're always learning. So that one is uploaded. I'm going to make it go live at about 5 p.m. so you guys will catch that one. Yeah, hit that bell icon or whatever it is you do. But I look forward to seeing you guys next time. Thank you all for joining me on this stream, and those handful of you that gave super chats, really appreciate that. So, all right, I'm going to cut it here. Thank you, everybody, and take care.